Hello, my name is Nathan Larraguibel, and I'm going to be explaining to you about the economic and monetary policy of the European Union. First of all, we're going to be starting with the definitions of economic policy and monetary policy. The economic policy is a course of action that is intended to influence or control the behavior of the economy, typically implemented and administered by the government. And a monetary policy refers to the actions undertaken by a nation's central bank to control money supply and achieve macroeconomic goals and promote sustainable growth. These are the two primarily situations that we're going to be discussing today, as well as we're going to be reviewing the parts involved. In this case, in implementing and enforcing the economic and monetary policy, it's the European Central Bank, which is also known as the ECB, the national central banks, also known as the NCBs, and the member states of the Eurozone. The Eurozone is composed of all the countries that have adopted the euro as their currency. In this particular case, the first one is the European Central Bank, which is the central bank of the 19 European Union countries which have adopted the euro. Its main task is to maintain price stability in the euro area and preserve the purchasing power of the single currency. That way, the same amount or an average of the same amount that you have to purchase in one country will be the same in the different country that has the euro as their currency. Their primarily purpose is to set the interest rates at which it lends to commercials in the Eurozone. The Eurozone, as we already explained, is made up of the countries that are participating and that have the currency of the euro as their own. In this case, they also ensure that financial markets and institutions are well supervised by national authorities and monitors price trends and assesses risk to price stability. In this case, it is structured by a governing council, an executive board, and the general council. One of the primarily problems that we see is that not all of the countries that are part of the European Union are participating in the Eurozone. Why is this? One of the primary reasons for avoiding the Eurozone is to maintain their economic independence, as what may be beneficial for one country may not be economically beneficial for the other one. We are able to see that there are countries that have not participating in the Eurozone since its creation, like the United Kingdom, and we also see countries that have participated that have been affected by crises like the Euro crisis in 2010, like for example, Greece, that has not been able to recover from this since the crisis itself. One of the primarily reasons and also criteria that is needed for the countries to enter the Eurozone is price stability, sound and sustainable public finances, exchange rate stability, and long-term interest rates. Without meeting these criteria, the countries are not able to be admitted by the Eurozone and therefore are not able to have the euro as their currency. Some of the countries have been able to postpone this matter by not meeting the criteria and remaining with their own currency. And some of them are legally authorized not to enter the Eurozone, like the United Kingdom before the Brexit. In this case, there are also 5 economic tests that the United Kingdom had to follow prior to adapting the euro to their own currency. This was the business cycles and economic structures. The system has to have sufficient flexibility to deal with both local and aggregate economic problems. Adopting the euro must create conditions conducive to firms and individuals investing in the United Kingdom as well as others. However, the criteria created by United Kingdom prior to entering into the Eurozone was almost impossible to achieve. Therefore, they never entered the Eurozone. As well as we'll see that the Economic and Monetary Union represents a major step in the integration of the European Union economies. Launched in 1992, EMU involves the coordination of economic and fiscal policies, a common monetary policy, and a common currency. These are the states and these are the organisms that deal directly with the monetary and economic policy, as well as the national central banks that represents the member states. However, it is yet to be seen if the Eurozone will continue to be beneficial for the countries that are participating in it, or if it will become more than dangerous for those countries that are belonging to it. We also will be expecting to see that in the departure of the United Kingdom from the European Union may affect the perception that some members of the European Union itself, as well as the Eurozone, will see that they do not require or need the European Union itself or the Eurozone for the prosperity of themselves. But this will be one of the most interesting things that we will be able to analyze as internationalists, and I'm eager to see how this develops.